Back to Building Safety Faces. I'm joined today by good friend Nick Taylor-Ward from Konsileo Insurance, and Nick is an insurance broker that does lots of work in the buildings insurance world, amongst other things, and hoping today to understand a lot more about the background to where we've got to in terms of insurance price hikes and the whole subject of building insurance. So Nick, welcome.
Hi Matt, thanks for letting me participate.
No worries. Well, let's crack straight on. So I've mentioned there that you're an insurance broker. I think probably the best place to start is actually to explain what that means. What does an insurance broker do? How do you get paid? What do you add value to in this whole sort of insurance process? And then we'll take all the other parts from there.
Sure. Okay. Well, a good insurance broker will help the policyholder, the holder of the risks, to buy the right insurance policy. The insurance broker will know their market, they will know the client's business, they'll know their own business, and go to the market and find the best insurance solution. It might not just be on costs, but also cover, the quality of the insurer when it comes to service, and the robustness of the insurance policy to cover the risks that the client is seeking to cover. They're from an insurance point of view. So we get paid, in essence, a commission by the insurance company, and that's built into the premium. Or we then rebate the commission and charge a upfront fee, which is basically reduces the cost to the policyholder.
So you get, so you've mentioned there that you get paid either a commission, so a percentage of the value of the premium, or you charge a fee, which is a fixed amount to do the work that you've got to do. And I'm guessing that as the premium increases, it becomes more cost effective to charge, or for the customer to pay a fee than it does to pay the percentage.
Certainly, yes. If you're paying £1,000 premium, then it's better off for the policyholder to pay a commission, which is built into the premium. But if you're paying a premium of 20, 30, 40, 50,000 or more, it's more efficient for the policyholder to agree an upfront fee with the insurance broker, because the work is basically the same sort of amount of work. It might be more claims and everything like that, which the insurance broker will put into the equation and make a guess of how much work they'll have to do in that policy in the year. But it works out, the higher the premium, it's better to go on a fee basis.
And what would the typical sort of range of commission fees be in building insurance? And I know it varies from company to company, but what's the sort of the lower end of what you've seen in the market to the higher end? Is there a range you can give us?
An insurance broker who's client facing might get a 10% commission rate from a wholesale broker. That means whereby the current insurance broker goes to a larger insurance broker to get a particular deal, or the insurance broker could go direct to the insurance company and get a commission of between 20 and maybe 20. We would get probably between 20 and 27, but it has been known that insurance brokers could get up to 40 or over 40% on their insurance premium. So if you're paying £1,000 insurance premium, there could be a 45% which is element of commission. Now, something like that, if you're paying 10,000, 20,000, 40,000 or more, doesn't become a good deal. So we would then work on a fee basis, and we would rebate the commission back to the insurance company and agree an upfront fee, a transparent fee with our clients, which would save them money and also money on their tax, because the commission is built into the insurance premium, and so therefore it's taxable at 12%, which is the current rate of IPT. An insurance broker's fee is tax exempt from VAT and IPT, so it's a win-win situation all around.
So that can save people a lot of money, but how would you know if you're a resident within a block? How would you know what that commercial arrangement is in relation to arranging the insurance? So how would I know as a resident how much of my insurance bill is actually made up of commission or fees? How is there anything that the Financial Conduct Authority does to protect me as a consumer, if you like, to understand what that fee arrangement is?
Well, under the Financial Conduct Authority, the FCA rules and guidelines, a policyholder can always ask on fee or earnings disclosure. Now, that's fine if the residents, as a residential management committee, have arranged the insurance direct with the insurance broker. They can ask that question. The problem gets a little bit more difficult if they've arranged it either via a property manager or the freeholder has arranged it on their behalf, and it's the leaseholders who are paying the premium to the property owner, i.e. the freeholder. It becomes a little bit more tricky there. You can ask, but you might not get the answer because the relationship between leaseholder and freeholder is different to that of the insurance seller. Yes, it is. It's a question to ask. Sometimes the freeholders might add on an administration fee.
So I've looked into this a little bit and tried to get some sort of compliance consultants' advice on, they point you at the Insurance Conduct of Business sourcebook, ICOBS 4.4.1, I think it is, the section, but it talks about the customer or the policyholder, but it's not entirely clear at the moment whether the leaseholder downstream is actually the customer. So it's really interesting to see how that one plays out. But I think ethically, to my mind, if you ask for that commission disclosure, I can't see a reason it would be withheld. And I think if it is that, maybe that's the time to escalate the conversation. But we have seen people that have just asked nicely and they get a letter back or an email back saying, here's the commission that we've earned over the last 5 years arranging this insurance, and it comes back very quickly.
Yes, and it should do if the relationship is direct with the insurance broker.
Certainly, we've seen a lot of evidence recently where we've seen these huge insurance premium increases, which we'll talk about in a second as to why that might be happening. But the underlying commission percentage has remained the same percentage, just it's now 5 times as much money for effectively broadly the same work. And again, we can come on to how much work is involved in placing this insurance, because it's not like going on Compare the Market and putting in your car registration and popping out with an insurance policy at the other end.
No, certainly isn't.
Maybe that's a good place to start, actually, is sort of with this market being so difficult to place these large property risks now, and we can talk about why that is. How much work is involved in doing it, and how to do this properly? How far ahead of your renewal should somebody be starting the insurance renewal process?
Okay, so good questions there. Starting the renewal process should really be a continuous element. So if, for example, the client has just renewed their insurance on the 1st of February, now would be an ideal time to start looking and preparing for next year, the next 12 months. Unfortunately, a lot of people will think, oh, I've got over that and don't have to think about insurance for another 12 months. Wrong. At the moment, in this current market, you need to think. So let's have a look at the insurance presentation. Now, the insurance presentation is the proposal to the insurance market. Is it good? Now, depending on all the facts, a good insurance broker will get every part of the building construction. So we're not just looking at a brief description like it's standard, it was built in 2000. No, we need to look at the component parts. What is the substructure? What is it made of? Has it got a steel and concrete core? What's the cladding? And actually look at the materials used at the floors, the stairs, lift shafts, the fire features, the good fire features, the poor fire features. So look at cladding, look at insulation. Is it expanded polystyrene, EPS, and things like that, and just really get a full, great idea. And if the insurance broker says, well, okay, that cladding isn't really up to spec, you're going to have problems there, or the insulation or fire stopping isn't very good, let's address those and have an action plan and get quotes to sort it out. And I know a lot of people are looking at the cladding, but there are also a lot of other issues there, like insulation, the deckings, the timber, the fire stops, and stuff like that. So good insurance broker will do a comprehensive review, starting off with a survey, either by themselves or get a specialist in, and also collect all the health and safety documentation, if they've got a sprinkler, the type of fire alarm, when the fire alarm was installed. So it's a comprehensive fact-finding, gathering, and then piecing together a presentation.
So just on jumping in on that point, so one of the things that we're always talking about, and what we do, is obviously gather this information together around fire and life safety, maintenance, certification, all that sort of stuff. And I think it's really important to mention that the information that a regulator might want to see to prove whether a building's safe is exactly the same really as what an insurance company would want to see, it's what residents would want to see in terms of understanding how their building is managed. So this shouldn't be a duplication of effort, it should just be a seamless sharing of information that we call this risk-based decision makers would want to see, which ultimately is understanding the component part. That's the perfect world, but the reality is quite often somewhat different to that, isn't it, in terms of the availability of information and the quality of it. How do you see that?
Oh yes, definitely. There's sometimes an insurance broker will go to market with scant information, very basic information, which turns off the insurance companies. And there's a very limited amount of insurance companies there who are preparing insurance, and they don't want their time wasted. So a good insurance presentation to the market will give an insurance company the peace of mind. They'll understand the risk proposed, i.e. the block of flats needs to be insured, and understand the risk features, not be rushed into it. They may be able to get a pre-cover survey in place. That's whereby the insurance company goes around and has a look at the building and says, yes, okay, well, if you do this, that, or the other within a certain time scale, we're more than happy to present insurance terms for you. And the terms will be X with Y terms. Because at the end of the day, the insurance company will want to make money out of the client. They don't want to pay a large fire claim, and it's all about risk management.
Yeah, and I think it's really important for people that aren't aware of this. And I think a lot of people's interaction with customers' interaction with the insurance industry is, as I say, going on a price comparison site or something and plugging in some details and getting a policy out the other end. But the sort of risk we're talking about here, this is analog human to human discussion about a particular risk or a building, and negotiation, horse trading, and answering questions. So the sort of the faceless insurance company, it will actually be a human being in those that is generating a price for this block of flats that is being insured. So it's not an automated machine-based process, is it? It's a human process.
It certainly is a human process, and the underwriters, they need the documents there to understand the risk, photographs, drawings, plans, and everything like that. They need that to really get a good idea of where the property is and how it's managed, and get a good feeling for it. The better they're feeling, then the better the terms are going to be.
So the key point there is if you ask a building manager questions about the building and they can't answer them to you as a resident, then the likelihood is they can't answer that question to an insurance broker, which means that when your building goes into the market for pricing, the underwriters are not given the full picture. So the likelihood is they will err on the side of caution and add to the price. That's effectively how I see it.
That is quite true. I have seen an example whereby a client has come to me and said our premiums has increased dramatically from 35,000 to about 220,000. And they gave me a copy of the presentation, and it failed to admit that any sprinkler system was installed. And the sprinkler system was a very good system. It was a new modern system. They had a L1 fire alarm system in there. The fire brigade were just around the corner, at least 5 minutes away with the flashing lights on, and they were close proximity to a canal. So there was very good access, very good detection system, and fire resistance. And so with gaining that information, then we were able to present revised terms to insurers, a revised presentation to get revised terms. And that saved the client quite a lot of money. Many tens of thousands, in fact.
So that reminds me of a really good point we were talking about the other day, the mechanics of having a good broker and what happens when a broker takes a risk around the insurance market without selecting their or targeting the insurance companies properly. And then, so effectively, talk me through what happens in reality when a risk has been hawked around the market in a, let's say, in a bit of a slapdash or shoddy way. What then happens in terms of pricing and appetite to insure?
Well, in essence, it turns off the insurers. If you go to the whole market wide and it is impersonal, then the insurance companies, the underwriters there will pick and choose what they're going to go after. And if they feel that the presentation to them hasn't been made personal and it is going out market wide, they will simply decline to offer any terms because they're under pressure to write business and do business. And that can have a detrimental effect on the client, the policyholder too. So going to the insurance market, a sort of blank carpet bombing, we call it, and that will have a detrimental effect to the policyholder, because the insurance broker isn't taking the time, the care or effort of picking up the phone to a selected insurer and saying, would you like to work with me on this particular case, and making it personal. Now, a good insurance broker will know their market for high-rise blocks. The market is very limited, so there's no point in going to a handful of insurers. It'll be just a handful of insurers who they'll know who'll be able to underwrite the insurances, given the makeup of the property, the construction of the property. So if it has got cladding or any other combustibles, the property, then the insurance market is very limited. So a good insurance broker will make it personal, the presentation, and pick up the phone and have those conversations and work with that insurance company. And it might only be 2, 3, or 4 at the time. The detriment, if it's a poor presentation to the market, is that insurers will not be active and say, sorry, we're declining to quote, and give no reason for it. So if a next insurance broker does come into the marketplace, they'll realize that the market has been blocked by a poor presentation and they won't release terms, not for another 12 months at least. So that's why.
That relates, just jumping in on that, that also relates, and it doesn't happen too often, but where people think it's a good idea to appoint rival brokers on the same building. So two different brokers are taking the same risk out to the market, which again, I think would cause confusion as well, wouldn't it, in terms of who's got control over this and who's actually empowered to place this business?
It certainly does, yes. So it is difficult for a policyholder because everyone will be telling them, use me, use me, use me. And the policyholder won't know if to use their existing insurance broker. Better the devil you know is usually the common response, or to use another insurance broker. Because of the limited marketplace, a lot of insurers are saying, well, we operate on a first come, first served basis. So if any insurance broker goes there first and it is a poor presentation and they decline it, then all is lost. A second or a third insurance broker won't be able to access. So the best thing for any property owner or leaseholder or residential management committee is to choose one insurance broker to go into the market. But to choose that insurance broker, even if it is the existing, they need a copy of the presentation to make sure that everything is factual and paints a fair picture of what they are proposing to insure, and make sure it is comprehensive, because if the proposal is lacking, then it is to the detriment of the policyholder, and they will see either no insurance or their premiums increase.
Yeah, and I think this sort of relates into, I've talked about it a number of times before, and a few people have questioned this on social media around the decades-long soft insurance market that has now become a hard insurance market. So and the multitude of sins that are covered by a soft market. Could you talk us through, from your view, what the soft market is and what that does to insurance, and then what a hard market does, and then how that then overlays with Grenfell and the buildings insurance crisis now, but sort of starting with the soft market and hard market, just as an economic sort of trend, as a why do insurers effectively sell product at a price below what it's actually worth?
Sure. So there's something called competition, and in a soft market, insurance premiums will go down, gradually go down year by year by a couple of percent, 3, 4, 5, 6%, because insurance companies have been targeted to write a particular class of business. So, for example, in 2001, it was a very soft market, and at the end of 2001, following the atrocities of September 11th, sent us into a hard market whereby insurance premiums increased tenfold, and then over the course of the next 15 to 16 years started to drop away. So a soft market, premiums are low, insurance companies' capacity to write is high, and their appetite is very wide. They want everything. And unfortunately, underwriting goes out of the window, and an insurance broker's job is very easy in these conditions because the insurance company only wants bare minimum facts: the location of the property, how it's occupied, and the value, the sum insured. And they're happy to do that. Now, what's caught everyone out since Grenfell is how buildings have been, new builds particularly, and refurbished buildings have been clad, and modern methods of construction have meant that a lot of these new buildings are built with combustibles, maybe with the ACM cladding or EPS, expanded polystyrene, and expanded polystyrene is excellent for insulation, but when it catches fire, it's flammable and gives off toxic gases, which isn't good for to aid escape because of the breathing difficulties. But insurance companies have then realised, following heavy losses, multi-million-pound losses, not just at Grenfell, but other properties which have caught fire and burnt to the ground, that their premiums didn't cover the payouts. So a handful of insurance companies left the insurance market, the UK insurance market, in 2019, which is increased capacity and pressure. And these pressures have come tenfold, that insurance companies now require a keen eye for detail in the submissions or the presentation or the proposal to the market to detail the full construction details of the premises and any positive risk features, such as fire alarms, plans to remove any combustibles, sprinkler systems, and everything like that. So that is key. And the availability of insurance, rather than being 100% for anything which has got cladding, is reduced to about 1% now. And those insurance companies are very fickle. They are looking to insure the very best, and they would like to insure all the properties up and down the country, but they can't manage to underwrite everything. So they are being fickle and being cautious about what they write.
Yeah, I think it's I think it's important for everyone to understand that there's each of those insurance companies will choose what kind of risks they want to write. What do they want to underwrite? What sectors do they want to be in? Do they want to be in oil and gas? Do they want to be in building block management? Do they want to be in liability for surveyors? All these different markets that they can choose whether they want to be in or out, and if they want to be in, at what price. And I think that is something that I think is often overlooked in terms of how a market like this works. We can argue whether that's fair for a customer or not, but I can sort of understand commercially from an insurer's perspective why they might just think, do you know what, block insurance with anything that's got anything to do with cladding, don't understand it well enough, not sure how to price it. The easiest thing to do is to pick that insurance capacity up and move it to another sector or risk classification that I understand better and I'm less likely to lose money on. So I think that is my understanding of why such a lot of this capacity or capital has left the risk class that we're talking about right now.
Yes, you're quite right. I mean, any presentation, if it says that it's clad, even if it is concrete cladded from the sort of 60s, will automatically be a decline for many insurance companies just because they can't underwrite cladding full stop, and they won't move any further. They see the word cladding in the presentation and walk away, and it might be non-combustible. And yes, it is insurance companies buy reinsurance, and some of the reinsurance treaties will say no cladding full stop. And so they're going to be picky and choosy. Following the Grenfell disaster, um, insurance companies have reduced their capacity from say 50 or 100 million down to 20, 5 or even £1 million per location, especially if there is flammables or cladding known in the construction of the property. And that has a dire effect in the insurance market. So you might find a property which is worth a sum insured of about 20 million, which is cladding. You may have several insurers subscribing to get to that 20 million if the broker can source the full £20 million worth of cover.
That's a really important point, Nick, to explain. So that's if, so let's say we need to insure the building for £20 million, and
Yes.
each of the insurers are only willing to extend cover for £5 million. We would then need 4 insurers to stand together to deliver the £20 million worth of cover. So one of the things the broker will be doing is taking that risk around and getting each one to sign 5 million until he or she has got the 4 that make up the 20. So that's why I think for people watching, they may well have seen that last year their insurance was provided by company A. This year it's company A, B, C, and D.
Yes.
And that's why it is they're sharing the risk between them. Is that correct?
Yes. Oh, that is because no a single insurer feels that they can take the hit, really. And so they're sharing the risk. And that is all about insurance, really, is sharing the risk. And sadly, if there is a fire, then insurance companies say that the EML, the estimated maximum loss, is going to be 100%. So the fire starts off low and it'll spread upwards generally. So therefore, it'll be a total loss, and the insurance company will have to pay out the full amount of sum insured. And that's something which they are protecting themselves, the insurance companies.
Yeah, and if you look at a large claim, I mean, if everybody in the building gets out, so we have minimal or no casualties as a result of a fire, then the big check that needs to be written will be one for the damage to the building, I'm guessing. And if you've got this total loss event, which is the building, the fire gets into the cladding and it spreads up, down, sideways, and around like a Grenfell, then you're into maximum sort of payout territory on the property side, which is a very big bill for an insurer it's a very big hit for them to take.
It certainly can be, yeah. So you will have the building sum insured, let's say £20,000. So it may be that the building needs to be demolished and the debris removed.
20 million, I think you meant to say.
Sorry, 20 million. Yes, 20 million. Sorry. So the 20 million. So the property would have to be demolished, the debris removed, planning and professionals to go in to redesign, and it might be that building costs 20 million, but to rebuild to comply with new building regulations, it might need to have a sprinkler system. It might need to have the top grade fire alarm if it didn't have it. The cladding would have to be replaced, and probably to have a new non-combustible, more expensive sort of cladding. So all these have to be built into the factoring that. And so therefore, the sum insured might not just be the £20 million payout, but it might be additions as well. So it's very important to make sure that the building is insured on the right basis. And I would always suggest that an insurance reinstatement cost assessment is taken out at least probably every 3 years to keep on track of the cost of building materials and regulation, so clients aren't caught out with underinsurance, whereby the insurance company says, well, we believe that the property should have been insured for 30 million and not 20. But yeah, insurance companies are always looking for a safe bet and not to, in essence, have to pay out.
So
Of course.
jumping in again with a translation, because you mentioned something really important there about underinsurance. So the what will then happen? Can you talk us through average and how average is applied, if that were to be the case? Because I think that's really important for people to understand what actually happens or what could happen if the sums insured are wrong and it comes to a claim.
Okay. So in the very simple basic is that, let's say, for example, a property is insured for 100 million pounds, let's say, but the true cost of rebuilding is 200 million pound. There is a total loss, and the insurance company comes around and says, right, okay, well, we believe that the property has been underinsured, has been insured for half its value, because we believe it should have been insured for 200 million, but you've only elected to insure for 100 million. In the best case scenario, the insurance company will pay half the sum insured on the argument that they have been outdone premium. So they wouldn't pay the full sum insured, they'd only pay half of it if they could prove that it was underinsured, which leaves a policyholder vastly out of pocket. Where they should have got 200,000, they've only got 50,000, and they could have lived with 100,000. Now, in the current insurance climate, an insurance company could say, if it's arranged on a commercial basis, could say, well, we were you were misrepresented and we refuse to pay the claim. Now, that wouldn't be good brand publicity, but under the laws of the Insurance Act, they could avoid liability and misrepresentation if it was or they led to it to being fraudulent, which is a situation we'd never want. So it is of the utmost importance to get the sum insured correct. There are more technical issues about getting the sum insured correct as well, which we can talk about, but yeah, the whole complex issues about average is basically getting the sum insured right at the start of the
Okay,
insurance.
and then just as we're on claims, so again, this is really important, I think, to understand is that when an insurance claim goes in for 50 million or 100 million or whatever it is, that will be subject to a lot of sort of detailed investigation and due diligence by the insurer to assess that claim. And at that point, maybe some, or probably, a lot of the conditions in that policy that needed to have been met will be tested. So they will come back and say, was that alarm system maintained effectively in accordance with the insurance policy? And my view would be you better be able to answer those questions positively. Otherwise, it's going to be another reason for that claim not to be paid potentially. So it can get quite adversarial, especially when there's big sums involved.
Oh, certainly. Yeah, the larger the claim, the more investigation, the more due diligence the insurance company is going to be looking at. And if the property owner, or the committee, whoever's looking after the management of the building can say, yes, we did this, we've done that, we've done the other, the fire alarm was tested, we do weekly sprinkler tests and everything like that, and everything is all monitored on a weekly or a monthly basis, then that will give the insurance company peace of mind. Right, okay, they've done everything, the sum insured is fine, is spot on, they've done everything, and that we have got no excuse not to pay the claim, and we will expedite with the repairs. Delays do occur when the documents can't be produced. So one of the key documents nowadays would be a valuation on the building, and that would be an insurance reinstatement cost assessment to make sure that the building was insured, and also to make sure that all the requirements of the insurance company have been met as well. If those documents can't be produced or there's a delay, that is going to cause a further delay in getting the claim paid. So yes, if somebody can produce those documents fast and efficiently, then thumbs up all around.
I think it really is about the detail. I mean, we've talked about detail all the way through. So there's the takeaways for me, Nick, are you start thinking about renewing your policy the moment you put the new year to bed, if you like, within a few days of the, especially in this hardening market. So you get on with it. You make sure you've got your records together and that they're up to date and they're available, and you actually do what you've agreed to do within the terms of the policy. You don't just sort of ignore it and put it on the shelf and then worry about it after the fire or after the flood. You make sure that, you know, this is a super important contract that needs to be properly understood and managed by everybody.
Due diligence by the policyholder and all concerned when buying insurance must be carried out, because the client must understand the insurance policy before purchasing and during the purchase, and adhere to everything, because just like any product, if it's a cup, you can see it in the shop, you can feel it and see if it's right for you. With insurance, you're not going to know until it pays out. And yes, you can trust your insurance broker, but you yourself, the buyer of insurance, must have a good read of the policy and understand it, so to make sure you comply with it in full terms. And so we all hope we don't need to use it, but if you do need to use it, we'll make sure you are complying with the policy, because you can only test it when you're making a claim.
Yeah, and just to summarise and finish up, it's been great talking to you. It's been really useful, Nick. What are the key things that, you know, if you're living in a building that's been on the receiving end of a huge premium increase, which we've seen reports of 400, 500, 1000% premium increases, what would your advice be in terms of what to do next? I mean, how should you proceed? Because as you've said, very rapidly we're going to be into the next renewal cycle. So what should people be doing today, tomorrow, to help head this off at the pass?
I think the first thing is to do an analysis of what the incumbent broker has done for you. If you're the empowered insurance buyer, either by an RMC or you're the freeholder, then have a look at how your policy was sourced. Was it sourced direct from a broker? Was it through a managing agent or anything like that? And look at the relationship between the ultimate buyer and the ultimate insurer, and see how many middlemen are involved there. Obtain a copy of the presentation to market. Have a look how good that is. Also, have a look at the associated documents which was provided. Was there a building survey? Was there a reinstatement cost assessment? Was there a fire plans and details of sprinkler system and alarm systems sent to the insurance company, and full details of the construction? And if you have any concerns there, that's one point to speak to somebody like myself. Also, if the premium has increased, have a look at commission disclosure or earnings disclosure, and find out how much earnings are in the actual premium or the cost of insurance compared to what you paid. Because collecting a 20-25% premium on something which is paying £5,000 or £10,000 is perhaps justifiable, but if you're then paying £100,000 or £200,000 premium and there's a commission there, then maybe it's not fair for you and it's not moral, and look about negotiating a flat fee. And a flat fee would be calculated on how much work that broker needs to do. One, to secure the right information. Two, to administer the insurance policy. And three, to deal with any claims, and that should all be taken into account. Now, higher the premium, the bigger the savings you can make on working for a fee. So it's really having a look at the presentation, the relationship, and the earnings. And if you're not happy on any of those 3 points, speak to somebody like me, and then we can discuss early doors about the best route to market. And that might be to appoint a new insurance broker and to work with them, gathering the fact find in a tri-party relationship: broker, insurer, and buyer.
So I've broken with tradition on this, and I've actually asked Twitter asked impacted residents on Twitter if they've got any insurance questions. So although we're not doing a live Q&A, I'm now looking at my phone and looking at my Twitter feed to pick out a few questions. So first one, will the presence of a waking watch and temporary fire alarm system mitigate the need for insurance hikes? So I think we've covered a bit of that, but let's just talk about what impact waking watch and temporary fire alarms has on premiums.
Well, I suppose the fire alarms themselves are is an early warning system. Now, one of the troubles is that the cladding and or insulation, like expanded polystyrene, can rapidly engulf a building. So expanded polystyrene, if a fire gets inside it and at quite a low level, the fire can rip through the building unnoticed quite quickly. So depending on the fire alarm system, that can be an early warning system, and likewise waking watch will get the residents out. Now, when the fire brigade turn up, and because it's a high-rise block, there may be very little that they can actually do. So it's more really save the life of the occupants and not really the protection of the building. Both systems are really life-saving and not the building protection. So in fairness, it is a requirement for insurance companies, but at the same time, they have little effect if there is a fire.
Okay, great. And so leading on from that, question about, well, two questions actually related to each other around why aren't insurance premiums capped, or why aren't they capped at a maximum sort of certain increase per year as you renew, rather than having these sort of wild premium hikes? So
yes,
talk us through that.
Yes, well, I suppose it is competition. And we spoke about the soft and the hard market. In the soft market, there's a lot of competition and premiums go down.
And everyone likes, that's the
oh,
thing.
And everyone likes that. Yes, yes.
Yeah.
So 15 to 18 years ago, you might have been paying £100,000 premium, and it might have reduced to say £20,000 a couple of years ago. And now it's starting to go up. And the upwards motion, nobody likes, and they do increase quite rapidly, and that's because there's an exit or lack of competition in the marketplace. And it would be nice to be able to cap them, but whilst insurance is regulated, the price and availability isn't regulated, and insurance companies can't be forced to provide insurance. It is a difficult question. I do sympathise with the people who are buying the insurance, because it does shoot up from time to time, and the cycles are usually something between every 15 years on average, whereby they go down and then they shoot up. In a couple of years' time, we should see new entrants to the market, which will then put place competition, and we'll see the prices to go down. But in the short to medium future term, then we are looking at high costs. And yes, because insurance companies are there to underwrite the risks and the availability of insurance for them, and they're capped of how much they can write. The cost of insurance has gone up, unfortunately.
I think we can see if we look. If you mentioned the last hard market in the early 2000s as a result of September 11th. But if we then look at when a lot of these combustibles started appearing on buildings, it pretty much mirrors to the softening market for the last 15 to 20 years. So I think my supposition is that a lot of what insurers would have had a problem with being on a building in terms of how they reflected that in the insurance price was probably masked by overcompensated by the desire to write business in a soft market. So actually the punishment, if you like, if you could call it that, for combustible facades wasn't a proper punishment, because there was an overriding force, which is we need to write business because it's a soft market. There's too much cash here.
Yes, I mean, I've been an insurance broker for 30 years, and I know what's combustible and what's not combustible. And speaking to insurers in, say, 2015, and you could pick up the phone to somebody and say, I've got this opportunity to insure a 40 or 50 million pound property. It's got this cladding. Are you comfortable with it? They turn around and say, yes, we're comfortable with it. And they say, yes, we'll give you a premium indication of this. So yes, quite frightful, really, that underwriting went out of the window, and now insurance companies are fearful of anything combustible, especially when the sums insured are over 2, 3, 4, £5 million. It becomes problematic.
So just to wrap up, and I know I keep saying we'll wrap up, and then we will wrap up this time because we've got to go. What is your view, Nick, in terms of where the market's going to go? Do you think we're going to start seeing more capacity coming back in and prices coming down, or do you think we're going to see further price increases for a period of time? I mean, looking into your crystal ball, where do you think we might be headed?
Well, for the time being, we're definitely seeing probably price increases for the time being. There are a lot of properties out there which have, in essence, escaped the rate increases. And the insurance companies will say, right, okay, we're looking at this the long term, and they'll be increasing maybe by 30, 40, 50% or something like that, or even more, and getting to a level where the insurance company are comfortable. We do need new competition and new entrants to the market, but I can't see that probably for the next at least 12 months. I wouldn't have thought, if not 18. And these cycles have to play out. They'll gradually tear off and then drop away. But I would say 12 to 24 months. After 24 months, we should see them dropping down, hopefully. In that time, hopefully the combustibles have been replaced, and everything is sweet and dandy, and prices will then start to fall, especially if we have new competition. So and the new competition might come in and say, well, if you're insuring it for paying £1 million, we can do it for 800,000, and that'll create stimulus in the marketplace and start to reduce premiums.
Okay, well, that's a positive note to finish on. It would have been good if it was, yes, next week, don't worry about it. As soon as March starts, we're all good. But, at least we can see some light at the end of the tunnel, hopefully, for the premiums normalizing and reducing, but maybe never getting back to where they were a few years ago, but certainly get back more towards affordability for most people.
Yes, certainly, yes. We've got to, and no one likes paying their insurance, regardless of what it costs, and it is a bit of a pill to swallow if your premium has gone up 400, 600, or 800%. It's terrible, and my heart goes out to those people who are living in blocks which they don't feel safe in. Never mind the costs as well. Yeah, so my heart really does go out to them, and if there's anything I can do, I'll be more than happy to.
Brilliant. Well, thank you very much for your time, Nick. That's been really useful. And I think if anybody has further questions, then along the bottom of the screen will be your Twitter handle. So as it's Building Safety Faces on Twitter, so they can get in contact with you and ask you a question. And I'm sure if they're asking a question where you can't answer it for regulatory reasons, you'll tell them, and you'll tell them why.
Oh, sure. Yes, I'd be more than happy to field any questions and anything like that. Yeah.
Perfect. Thank you very much, Nick.
Cheers. Thank you very much, Matt.
Bye-bye.
Cheers. Bye-bye.